Greetings, class. This is an announcement video slash lecture video for Finance 101 for Wednesday, April 1st. And I am in an announcement I made last week, and I wanted to kind of bring you up to date on some adjustments I'm making to this announcement. Now, I'm still holding virtual office hours. My initial idea was to hold a WebEx meeting and have it open for those hours and allow students to drop by the virtual meeting and just ask questions if they wanted to. And that was a good idea. But one of the issues that we've had with WebEx since we've started online has been the number of people accessing it at one time. And so what I've decided to do is to say, okay, I'll be available during these office hours to meet with you or anybody, any student who wants to meet. However, I am going to say here that I need to have some advance notice and an appointment where we can actually come in contact with each other through WebEx, or if you prefer Skype or Google Hangouts. Those are three that I've used in the past, and if you want to do one of those, I'm happy to accommodate you. But what I won't be doing from this point forward is just sitting there with my computer open meeting in WebEx, just using the bandwidth while I don't have any scheduled meetings. So I'm not just going to leave it open during those hours, but if you want to meet, send me an email, contact me. I'll be glad to do that. Okay, so I want to go to Chapter 8. Here we're going to talk about investing. And really the focus that we're going to be dealing with in this chapter are these first four items. And I'm not going to spend a lot of time with trading and valuing, although we'll talk about that in these other sections as well. But what we are going to talk about is what a stock is, how is a bond different, what are the benefits and options that mutual funds provide. Those are the things we're going to cover. So a stock is basically purchasing ownership in a company, and when we do that, we're buying a little piece of that company. So if you have a share of stock in a company, the company may have 10 million shares of stock outstanding, so you have one small piece of that company. If you own shares of stock in a company, it gives you the right to vote for the board of directors, to attend annual meetings, and do a few other things. Although in a corporation, stockholders don't have a voice in how the business actually is run. So the publicly traded stocks, you buy them on the stock market. Most people are not going to be able to find these privately held stocks because those are things that are issued usually to a family group. And there are examples of that around where an individual family started a business, incorporated it, and actually all of them are shareholders in the company to one degree or another. So how do you, why do you even get to stocks? Well, this is an illustration. It shows Bill, the cupcake maker, and he wants to expand his business. Well, when he starts, he'll use money he's got saved, maybe borrow some money. But if he wants to do some major expansion, that's beyond the capacity of the bank to actually loan him that money. In the example I have on this PowerPoint, he wants to borrow $10 million. Well, the bank is not going to do that. When you do that, that's when you have a couple of options. You can either go out and issue shares of stock, which is what Bill decides to do. And he goes through an underwriter, and an underwriter's job is basically to look at the stock and the company and the financial condition of the company and decide, okay, what is this stock really worth, and how much can we raise when we sell it in the market? Once Bill sells those shares of stock in the initial public offering, the company will then be owned by all the shareholders, and he will have raised the money he had set out to raise, hopefully. So once the share is out in the market, it's been sold to somebody in the IPO, which is initial public offering. If you want to basically make a little money on that stock, say you bought into the IPO at a lower rate and the price of the shares have gone way up, you can sell that share of stock, those shares of stock, in a secondary market. And when we talk about that, that's where you're talking about the New York Stock Exchange or the NASDAQ or something like that. A bid price is going to refer to the highest price that a buyer will pay for that specific stock or the number of shares of stock at a given time. So you have buyers who are bidding to purchase stock at a certain price. You have sellers who are selling stocks, but they're asking a certain price. Okay, so their ask price is the lowest price that they'll take for their shares of stock. Really, when we talk about buying and selling these shares of stock through a stock exchange, anymore there's a lot of this that's done electronically. However, there is a physical stock exchange presence, and you can see that, and often we see clips or video clips of it on the news, especially with the valuation of shares of stock having fallen in the last few weeks as they have. Basically, you'll see snippets or pictures of or videos of typically the New York Stock Exchange. There are other kinds of exchanges too that are not necessarily physical in nature, that you can actually electronically make transactions. But once you actually own stock, you have the right to do a few things. You can vote for the board of directors. You can attend annual shareholder meetings. You can also expect some share of the profits of the company. And typically, those shares of the profit of the company are going to be paid out in dividends. So you may receive a quarterly dividend on your shares. So the firm basically the investors are allowed to appoint the managers of the company. Well, that means the board of directors. And you really don't get to appoint who you want. Shareholders get to vote on a slate of candidates that are pre-approved, and typically that happens at the annual shareholders meeting. If you want to make money on your stock, you sell it in the market. That's one way to do that. But another way is to basically look at the profit of the company. In this example, Bill is making a profit on each cupcake of 10 cents. So let's say he's selling 10 million cupcakes and he gets $1 million in profit, and you're a shareholder, you get a little piece of that profit. The way we measure what share of the profit you have is called the earnings per share. And what this means is you take the net income from the company, or the net profit, and you spread it out over all the shares that are outstanding. So in this case, they look at this, they show the calculation of the net profit of $1 million. How many shares are in the market? Okay, that's $1 per share, the earnings. Now, just because their earnings per share are $1, it doesn't mean that you'll receive that much in dividends. Typically, part of the earnings are restricted for future expansion or some other project, but there are usually a portion of the profits will be issued in a dividend to the stockholders. Okay, so buying and selling shares will make you money, like I said, sometimes, depending on if you bought in when the stock was at a low price and you sell when it's increasing. You're going to make money that way. You'll also receive earnings from the company in the dividends that I explained. So, an example, a company, well, not for profit that I worked for several years ago had somebody give the company, give the not for profit some stocks in Exxon. And so they basically took those shares of stock and put them in a safe deposit box and didn't really pay too much attention to them over time. However, at the time that I worked there, they were receiving quarterly dividend checks from Exxon, and at the time, Exxon was making a lot of money, so the dividend checks were rather large for that not-for-profit. So usually the dividend payments are a portion of the profits and not usually a large portion of the profits, but it can add up if you have a number of shares. I'll say there are three kinds of stocks that we would look at. Well, actually two, but then we could get a combination, a hybrid. You have growth stocks, which basically are looking at new companies starting up that are expected to grow and have some share of the market expand for them over time. And then you have companies that pay large portions of earnings in dividends. Not all companies do this, but some do. And those are considered income stocks. So if you want growth stocks, many of these are going to be in companies that are on a growing trend, and they may be, you may have a little more risk in those growth stocks because they haven't been as established as other large companies. Income stocks are typically going to come from those large established companies. Like I mentioned, the Exxon shares owned by the not-for-profit that I work for, those were income stocks because that not-for-profit was at the time receiving about $1,200 every quarter, which really did a lot for its budget. Now, if you are looking at a growth stock, you're not necessarily going to be looking for that kind of payout, but you are looking for an appreciation in the value of the stock. Now, there are combination stock pricing, a way of looking at stocks in a combination of ways. You can get a combination of stock price appreciation and the dividend payments as well. And those are companies that are sort of in between the big established firms and the growing firms. And there may be a lot of growth involved in those as well. But those are going to be sort of a combination. The income stocks would be for like I said, the established companies. Okay, if you want to buy or sell stocks, usually you have to have, well, you do have to have a brokerage account. You'd put money in it and you buy their stock or whatever stock you wish. There are several kinds of brokerage houses like Merrill Lynch and Edward Jones. In these cases, they're going to give you some pointers on buying and selling stock or give you advice. The online brokerage firms or ones where you go online and you purchase and sell stock there basically on your own. You need to have your own research. Three major stock exchanges in the U.S. are the New York Stock Exchange, the American Stock Exchange, and NASDAQ. And NASDAQ is a stock exchange that usually has some of the more high-tech companies. The New York Stock Exchange is where you see the Dow Jones Industrials and typically where you see blue chip companies. NASDAQ has some large companies in it too as well, but this is usually a place where you find more tech companies. Now this is an important valuation, but for your sake, I'm not going to go through the calculation. I just want you to know that the stock value can be based on the dividend growth over time. And there is actually a formula here to calculate that if you want. Basically, it looks at the traditional growth rates that a stock has in dividends, and then it basically computes that going into the future based on historical trends, and then looks at what your return is that you want. The price earnings ratio basically is just looking at, okay, how much am I paying to get those earnings? How much do I have to pay to get a dollar of current earnings? And usually this is going to be a higher number than the $1 earnings. So you're looking at, here typically between 10 and 30 is the PE ratio. Another way of valuing or looking at stocks is it by market capitalization. So you have these basically companies that are classified according to market capitalization. Greater than 10 billion is a large company stock. It's large cap, and there are companies that are even larger than this. In fact, I think it was about a year or two ago. I don't know where it's at now if the stock changes the way they are. But at one point, Apple was capitalized at over $1 trillion. So you have companies like that that are just really, really big. Then you have these medium companies. They call these medium, $2 to $10 billion in capitalization. And when we say capitalization, we mean what is the value of their stock in the stock market. So you're basically looking at any given day, okay, what stock is outstanding and what is its value in the market? What kind of shares do they have issued? What are the value in the market? And basically that will tell you whether it's a large capitalization, a mid capitalization, or a small capitalization. Now it says here anything under 2 billion is considered a small company stock. Okay, I don't want to go into that too much in depth, but I do want to talk about bonds next. Now, a bond is different from a stock in that you don't buy ownership in the company, but you're loaning the company money. If your focus is I want to have a relatively low risk investment and I want to have continuous income, then a bond will provide a low risk level of fixed income. So you can typically, if you're buying a bond, most people are going to look for the most secure company they can find and purchase bonds from them. These will provide fixed income at intervals, usually every 6 months. And the companies, when they issue these, they can deduct the interest that they pay. So that's a little bit of a tax incentive for them. It also helps you as an investor diversify your portfolio and when we say diversify, what we mean is you don't want to have all of your investments in riskier stocks. So you want to split that risk out somehow or balance it out. So you may want to have some money in growth stocks. You may have some money in income stocks. You may have some money in bonds. And that's where this would come into play. And that's what they're talking about here with asset allocation. It's basically deciding, okay, at this point in my life, I need this much in stock, this much in bonds, this much in income stocks or whatever. But you can spread the money across these different assets. And what it does is it doesn't stop all losses, but it protects you because typically when stock prices drop, bond prices go up and vice versa. So here's what they're showing for an example on a long-term asset allocation. If you're younger, you can risk more because you can recover. They're saying 85% in stocks, 10% in bonds, 5% in cash. The interest that's calculated on bonds is a lot like the interest you calculate on any loan. You're basically going to, with a bond, you're going to calculate interest every 6 months and pay that to the bondholders. And usually that's what they want. They're looking for that income. So here are some definitions for bonds that are important. The face or par value of the bond. Now, They would print up a bond certificate in the past, and you could see that, and around the edge there were these coupons you clip off and redeem those at the bank. Uh, so a lot of this language comes from that time when they made bonds, when bonds were like that. What you have is you do have a face value on a bond. So when you issue bonds, these documents, they really are documents that are issued, you have a face value or par value on the bond. Most of the time, bonds are sold in increments of $1,000. So each bond would be $1,000. That's what you pay to get it. And then the maturity date is when the bond actually, the company will pay you back the money you loaned them. And then finally, the coupon rate is also stated on the bond, and the coupon rate is really the interest rate. And then finally, the coupon payment is most of the time it's going to be the face of the bond times the interest rate times 6 months divided by 12, because the coupon payment is going to be um, factoring in every 6 months the interest rate that you get on the bond. Okay, the composition of the bond market looks a little like this. A lot of bonds in the market are treasury bonds, and those things are considered to be very, very safe, very secure, and actually, by definition, risk-free, because the government will always be able to raise money through taxes. Uh, there are mortgage-related bonds, uh, but really the bulk of these that you're going to see outside of the federal government is going to be corporate bonds. Now, when I worked in auditing, there were typically the way a hospital, when I was doing the audits, the way they raised funds to build a new wing in the hospital or a new project is they would issue these bonds. And I remember auditing a bond issue at a hospital where they issued bonds valued at $30 million to build an ambulatory surgical area and some other things as well. So they do that. They issue these bonds in order to raise that money, and those would fall under corporate bonds. State and local government bonds are different in that you don't pay taxes on those. Uh, they're tax free. Corporate bonds generally are going to involve people looking at higher coupon rate and a longer maturity date. So if you're looking for corporate bonds, you may have a little bit higher risk as well. So, but usually you get a higher coupon rate and longer maturity. There have been a lot of folks who speculate in bonds. They used to call these junk bonds. In the 1980s, there was a big scandal, really. Uh, this one investor went to prison for it, but he was manipulating junk bonds. And basically, what that means is that the bond is worthless. The corporation will never be able to pay it back, or likely won't. But there might be some cases where you buy these junk bonds and you have somebody resuscitate the company, and you actually do make money on them. It's like buying penny stocks. Treasury securities fall into these categories. T-bills are 1 year or less. 1 to 10 years is going to be a note, and 10 to 30 years are bonds. These state and local government bonds are really going to be those that are tax exempt interest. Like I said a moment ago, you don't pay tax on the earnings you have with municipal bonds. That's why they're attractive. Um, Now, one of the ways to tell how risky a bond is to look at the rating agency and how they valued those bonds or how they rate those bonds. The two most well-known rating agencies are Standard & Poor's and Moody's, and they give ratings that look like this. You see AAA, Standard & Poor's, is their highest rating, or A, It's a little different. The two lowercase a's, that's a Moody's rating. So those are going to be a very reliable, high probability of you recovering your money. Those with lower ratings are going to be like C bonds with a rating of C. You may not get the money back if you invest in that. And usually the junk bonds would fall into this D category where you're not going to get your money back typically. Um, when you're looking at the face value of a bond and figuring out what it's worth, if the current interest rate on the bond or the coupon rate on the bond is equal to the current interest rate, then you're basically going to have face value in the bond. You have to pay the full amount for that bond. If the current interest rate um, is less than the coupon rate, in other words, if your coupon rate is higher than what's being paid in the market, the value of your bond will go up. It will increase. In other words, people will pay you a premium for that bond. So it might pay somebody to pay you $1,020 for the bond because they're going to get higher interest. On the other hand, if the bond interest, the coupon rate, is less than the current market rate, then you're going to sell those bonds at a discount, which means that instead of paying the full price, you're going to pay something less. Now, to expand on this, when you're selling bonds or buying bonds at a premium, the way they express that in the market is they describe it as a percentage. So if you were buying bonds at a premium at 102, that means you're paying 102% of the value of the bonds. On the other hand, if you're buying at a discount and you're paying 97 on a bond, that means you're getting a discount of 3%. That means you're paying 97% of the bond's face value. The last category I want to touch on here are mutual funds. And a mutual fund is an investment, a collection of investments. It's a collection of different companies, different kinds of securities. And what a mutual fund does is it sells you a share in the mutual fund, which is a little slice of every one of those stocks. The reason these work so well is because you're diversified by buying into the mutual fund. You don't have to make up your own diversification. You don't have to figure that out on your own. You can go to a mutual fund where they pool investors' money, buy these shares of stock, bonds, whatever they're buying, and then you share in the income from that fund. The advantage is that they allow you to diversify your money with a very small amount of investment. So you avoid this risk of being all in one kind of investment or another. So risk is divided into a couple of categories. One is the systematic risk, which is kind of what we're seeing now. This well, it's not really based on the system itself, but it's a risk you cannot eliminate by going out and diversifying your investment. Systematic risk is what happens when you have a market problem. Risk that can be reduced through diversification is unsystematic risk. And that's when you're saying, okay, well, if I bought this company alone and that company went out of business, I would lose my entire investment. But if I had a mutual fund that had some of that company in it, I would lose a small portion of my investment, not the entire thing. So, interestingly enough, there are I'll get to that in a minute. There are two kinds of mutual funds. One is passively managed and the other is actively managed. A passively managed fund is designed to mimic a particular index in the stock market, and actively is where managers actively buying and selling shares of stock in different companies in that fund. Interestingly enough, passively managed funds outperform actively managed funds. This is their growth rate, and that just kind of is very interesting to me. That passively managed actually does better than active. There are fees in mutual funds. Avoid these sales-loaded mutual funds, which basically you pay a commission either when you buy into it or sell it. You're wanting to find no-load mutual funds if possible. Also, keep fees to a minimum. There's a mutual funds expense ratio that's reported, and you can identify whether or not that expense ratio is too high or not. Usually, they range from 0.10% to higher than 2.5%. The lower you can get that, the better off you are. Mutual funds will invest in other mutual funds occasionally based on this ratio that they're trying to keep. And that's an interesting thought in itself, but you can buy into those kind of funds. Now here is the way, if you're getting older and you're getting closer to retirement, the percentage of your investment in stocks should start to decline, while your investment in bonds should start to increase. So what you actually see many times is in the beginning you can put a lot of money in stocks. Even if everything goes broke, you have some time to recover that investment. However, the older you get, the less time you have, and so that's what this means. This means the older you get, the less stocks you should own and the more bonds you should own. So that covers Chapter 8. I will be posting the homework and the attendance assignment later, probably tomorrow, not tonight, tomorrow, and it'll be due next week. So take care, everybody. Stay safe, and I will look forward to hearing from you.